Section 1.1 to Understanding Dividend Yield, a comprehensive in-depth analysis. 1.1 Definition and Significance. Dividend yield is a financial ratio that measures the annual dividend income generated by an investment relative to its market price. It is expressed as a percentage and calculated by dividing the annual dividend per share by the market price per share. The formula for dividend yield is, dividend yield equals, annual dividend per share / market price per share, x 100. The dividend yield provides investors with valuable information about the income potential of an investment. Here's why it is important in investment analysis. Income generation. Dividend yield helps investors assess the income-generating capability of a stock or investment. It indicates the percentage return an investor can expect from dividends alone, regardless of any capital appreciation. Comparison of investments. Dividend yield allows investors to compare the income potential of different investments. By looking at the dividend yields of various stocks or assets, investors can identify opportunities that offer higher income potential relative to their investment. Stability and consistency. Companies that consistently pay dividends often indicate financial stability and profitability. A consistently high dividend yield suggests that a company has a track record of generating reliable cash flows and distributing profits to shareholders. It can be an attractive feature for income-focused investors seeking stability in their investment returns. Income growth. Dividend yield can also provide insights into the potential for future dividend growth. If a company has a low dividend yield but a history of increasing dividends, it may be an indication of future income growth. Investors can assess the dividend growth rate alongside the current yield to gauge the total return potential of an investment. Risk assessment. Dividend yield can be used as a risk indicator. Companies with excessively high dividend yields may indicate financial distress or an unsustainable dividend payout ratio. A very high dividend yield may suggest that the market has doubts about the company's ability to maintain the current dividend level, potentially signaling underlying risks. It's important to note that dividend yield alone should not be the sole basis for investment decisions. It should be considered alongside other fundamental and qualitative factors such as the company's financial health, growth prospects, industry dynamics, and overall investment objectives. Dividend yield plays a crucial role in generating income for investors and evaluating investment returns. Here are some key aspects to consider. Income generation. Dividend yield directly influences the income generated from an investment. A higher dividend yield indicates a larger proportion of income relative to the investment amount. For income-focused investors, a higher yield can provide a consistent stream of cash flow, making it an attractive feature for generating income from investments. Total return. Dividend yield contributes to the total return of an investment. Total return is the combination of capital appreciation, increase in the investment's market value, and dividend income. Dividends can significantly contribute to the overall return, especially in markets where capital gains might be limited or volatile. Dividend yield helps investors assess the potential income component of the total return. Comparison of investment opportunities. Dividend yield enables investors to compare the income potential across different investment options. By analyzing the dividend yields of various stocks or assets, investors can identify opportunities that offer higher income potential relative to their investment. This helps in selecting investments that align with an investor's income requirements and risk tolerance. Dividend growth potential. Dividend yield can provide insights into the potential for future dividend growth. Companies that consistently increase their dividends tend to attract income-seeking investors. By assessing the dividend growth rate alongside the current yield, investors can estimate the potential income growth and overall return over time. Risk assessment. Dividend yield can act as a risk indicator. While a high dividend yield may seem appealing, it could also indicate underlying risks. Companies with excessively high dividend yields may have challenges sustaining the dividend payments or may face financial difficulties. Investors need to evaluate the company's financial health, payout ratio, and dividend sustainability to ensure that the yield is not driven by temporary factors or risks. Market sentiment and investor demand. Dividend yield can be influenced by market sentiment and investor demand. When interest rates are low, investors may seek higher-yielding investments, which can drive up the demand for dividend-paying stocks. This increased demand can lead to higher stock prices and lower dividend yields. Conversely, during market downturns or periods of uncertainty, dividend yields may rise as stock prices decline, potentially making dividend-paying stocks more attractive to income-focused investors. It's important to note that dividend yield should be evaluated in conjunction with other investment metrics, such as the company's financial stability, growth prospects, dividend history, and overall investment objectives. A comprehensive analysis of the investment opportunity should consider all relevant factors to make informed decisions. 1.2 Calculation of dividend yield. The formula for calculating dividend yield is relatively straightforward. It is calculated by dividing the annual dividend per share by the market price per share and expressing the result as a percentage. Here's the formula: dividend yield equals annual dividend per share / market price per share, x 100. To calculate the dividend yield, you need two key pieces of information: annual dividend per share. This represents the total dividends paid to shareholders per share over a year. It can be obtained by summing up all the dividends paid by the company during a year and dividing it by the total number of outstanding shares. The annual dividend per share is usually disclosed in the company's financial statements or can be obtained from financial data sources. Market price per share. This refers to the current market price at which the stock is trading per share. The market price per share is determined by the supply and demand dynamics in the stock market and can fluctuate throughout the trading day. You can find the market price per share by looking up the stock's current trading price on a stock exchange or financial platforms. Once you have these two values, you can use the formula to calculate the dividend yield. By dividing the annual dividend per share by the market price per share and multiplying the result by 100, you convert it into a percentage to represent the dividend yield. It's important to note that the dividend yield is a snapshot in time and can change as the market price of the stock fluctuates or if the company adjusts its dividend payouts. Investors should keep in mind that the dividend yield represents the dividend income relative to the current market price, and it should be considered alongside other factors when evaluating an investment opportunity. Certainly. Let's take a closer look at the components of the dividend yield formula: dividend per share and stock price. Dividend per share. The dividend per share is the total amount of dividends distributed by a company to its shareholders divided by the total number of outstanding shares. It represents the portion of the company's profits that is returned to shareholders in the form of dividends. Companies typically declare dividends periodically, such as quarterly or annually. The dividend per share can vary depending on the company's profitability, financial performance, dividend policy, and any changes in the dividend distribution over time. It's important to note that not all companies pay dividends, especially those in high-growth industries that may prefer to reinvest profits back into the business for expansion and innovation. Dividend-paying companies tend to be more mature and established, often prioritizing income distribution to shareholders. Stock price. The stock price, also known as the market price per share, is the current price at which a particular stock is traded in the market. It represents the perceived value of the company in the eyes of investors. Stock prices are determined by market forces of supply and demand. Factors influencing stock prices include company performance, financial metrics, industry trends, market sentiment, and economic conditions. The stock price can change frequently throughout a trading day based on investor perceptions, news, and market dynamics. The dividend yield formula uses the stock price at the time of calculation to determine the relationship between the annual dividend per share and the market price per share. It's worth noting that the stock price can be influenced by various factors that are unrelated to dividends, such as company growth prospects, market conditions, investor sentiment, and broader economic factors. Therefore, investors should not rely solely on stock price or dividend yield when making investment decisions, but consider them in conjunction with other fundamental and qualitative factors. By combining the dividend per share and the stock price in the dividend yield formula, investors can assess the income potential and relative attractiveness of a dividend-paying investment. Section 2. Interpreting dividend yield. 2.1 Comparison to other financial metrics. Dividend yield, earnings per share (EPS), and price-to-earnings ratio (PE ratio) are all important financial ratios used in investment analysis. Let's discuss the differences between these ratios. Dividend yield. Dividend yield measures the annual dividend income generated by an investment relative to its market price. It focuses on the income component of the investment and is expressed as a percentage. Dividend yield is particularly relevant for income-focused investors seeking regular cash flow from their investments. It indicates the return generated by dividends alone, irrespective of capital appreciation. Earnings per share (EPS). Earnings per share is a profitability ratio that measures a company's net earnings attributable to each outstanding share. It is calculated by dividing the company's net income by the total number of outstanding shares. EPS indicates the portion of a company's earnings that can be allocated to each share. It is often used to assess a company's profitability and is important for investors evaluating the earnings potential of an investment. Price-to-earnings ratio (PE ratio). The price-to-earnings ratio, often referred to as the PE ratio, compares a company's stock price to its earnings per share. It is calculated by dividing the market price per share by the earnings per share. The PE ratio is a valuation metric that helps investors gauge how much they are paying for each dollar of earnings. It indicates the market's perception of a company's future earnings growth prospects and relative value compared to its current earnings. Key differences: dividend yield focuses on the dividend income generated by an investment, while EPS and PE ratio primarily assess a company's earnings. Dividend yield is expressed as a percentage, while EPS is expressed as a monetary value per share. And PE ratio is a multiple of the earnings per share. Dividend yield is important for income generation and stability, while EPS and PE ratio provide insights into a company's profitability, growth potential, and valuation. Dividend yield is most relevant for dividend-paying companies, whereas EPS and PE ratio apply to all companies, whether or not they pay dividends. Dividend yield and PE ratio are often used together to assess the income and growth potential of an investment, as they provide different perspectives on returns. It's important to note that these ratios should not be considered in isolation. A comprehensive investment analysis should include other factors such as the company's financial health, industry dynamics, management quality, and overall investment objectives. Dividend yield plays a complementary role in assessing investment opportunities by providing valuable insights into the income potential and stability of an investment. Here's how dividend yield complements other investment analysis factors. Total return perspective. Dividend yield contributes to the total return of an investment. While capital appreciation, changes in stock price, is an important aspect of total return, dividend income can provide a significant portion of the overall return, especially in markets with limited or volatile capital gains. Dividend yield helps investors evaluate the income component of total return, providing a more comprehensive perspective on the investment's potential. Income generation. Dividend yield is particularly relevant for investors seeking regular income from their investments. By focusing on the dividend income generated by an investment relative to its price, dividend yield helps identify investments that can provide a steady stream of cash flow. This is especially valuable for income-oriented investors, such as retirees or those relying on investments to cover living expenses. Risk assessment. Dividend yield can act as a risk indicator. Companies that consistently pay dividends and have a track record of increasing dividends over time often indicate financial stability and profitability. A stable or increasing dividend yield suggests that a company has reliable cash flows and is committed to sharing profits with shareholders. In contrast, a very high dividend yield may indicate underlying risks or challenges in sustaining the dividend payments. By considering the dividend yield alongside other risk factors, such as financial health and industry dynamics, investors can gain a more comprehensive view of the investment's risk profile. Comparison of investment opportunities. Dividend yield allows investors to compare the income potential of different investment options. By analyzing the dividend yields of various stocks or assets, investors can identify opportunities that offer higher income potential relative to their investment. This comparison helps in selecting investments that align with an investor's income requirements and risk tolerance. Long-term income growth. Dividend yield can also provide insights into the potential for future income growth. Companies with a history of increasing dividends may indicate the potential for growing income over time. Investors can assess the dividend growth rate alongside the current yield to gauge the total return potential of an investment. This long-term income growth potential can be valuable for investors seeking to preserve and grow their income over time. It's important to note that dividend yield should not be the sole basis for investment decisions. It should be considered alongside other factors such as the company's financial health, growth prospects, dividend sustainability, and overall investment objectives. A comprehensive investment analysis takes into account multiple factors to make informed investment decisions. 2.2 Dividend policy and sustainability. While dividend yield can provide insights into the current income generated by an investment, it is not sufficient on its own to evaluate the sustainability of dividend payments. It is important to consider additional factors to assess the sustainability of dividends. Here are some key considerations. Dividend payout ratio. The dividend payout ratio compares the amount of dividends paid by a company to its earnings. It is calculated by dividing the dividends per share by the earnings per share. A high payout ratio may indicate that a company is distributing a large portion of its earnings as dividends, potentially leaving less room for future dividend increases or reinvestment in the business. A lower payout ratio suggests that the company retains more earnings, which can be used for growth or as a buffer during challenging periods. Free cash flow. Free cash flow represents the cash generated by a company after deducting capital expenditures necessary to maintain and expand its business. Analyzing a company's free cash flow is essential in assessing its ability to sustain dividend payments. Positive and growing free cash flow provides a company with the financial means to support dividend payments. Even during periods of economic downturn or business challenges. Historical dividend track record. Examining a company's historical dividend track record can offer insights into its commitment to dividend payments. Companies with a consistent and long history of paying dividends may demonstrate a commitment to shareholders and have a track record of generating stable cash flows. On the other hand, a company that has a volatile or inconsistent dividend history may indicate potential dividend instability. Business and industry fundamentals. The sustainability of dividends is closely tied to a company's overall financial health and the industry in which it operates. Factors such as revenue growth, profitability, competitive position, and industry dynamics can influence a company's ability to generate the necessary cash flows to sustain dividend payments. Assessing the underlying fundamentals of the business and industry can provide a broader perspective on dividend sustainability. Economic and market conditions. Economic and market conditions can impact a company's ability to sustain dividends. During economic downturns or periods of financial stress, companies may face challenges in maintaining dividend payments. It is important to consider the macroeconomic environment, industry-specific conditions, and the company's resilience to economic downturns when evaluating dividend sustainability. By considering these factors alongside dividend yield, investors can gain a more comprehensive understanding of the sustainability of dividend payments. It is crucial to conduct thorough research, analyze financial statements, and review company-specific information to assess the viability of dividends as part of the investment decision-making process. A company's dividend policy is influenced by various factors, and it can have a significant impact on the dividend yield. Here are some key factors that influence a company's dividend policy and how they relate to dividend yield, profitability, and cash flow. A company's profitability and cash flow are crucial factors in determining its dividend policy. Companies with stable and growing earnings and strong cash flows are more likely to have the financial capacity to pay dividends. Higher profitability and cash flow can support larger dividend payments, which can result in a higher dividend yield, retained earnings, and growth opportunities. Companies that retain a significant portion of their earnings may have lower dividend payouts. They may choose to reinvest retained earnings back into the business for growth opportunities, research and development, or acquisitions. These companies may have a lower dividend yield as they prioritize reinvestment over immediate dividend payments. Business cycle and industry dynamics. Companies operating in cyclical industries may adjust their dividend policies based on the economic environment and industry conditions. During periods of economic downturn or industry downturns, companies may reduce or eliminate dividend payments to conserve cash. This can result in a lower dividend yield. Conversely, companies in stable or growing industries may have more consistent dividend policies and potentially higher dividend yields. Debt levels and financial health. A company's debt levels and overall financial health can influence its dividend policy. Companies with high levels of debt may prioritize debt repayment or interest obligations over dividend payments. A company's financial stability and ability to generate sufficient cash flows to meet its financial obligations are important considerations in determining dividend sustainability and, consequently, dividend yield. Regulatory and legal constraints. Some industries and jurisdictions have specific regulations or legal restrictions that govern dividend payments. For example, regulated utilities may have dividend policies dictated by regulatory authorities. Legal constraints can impact the dividend policy and, consequently, the dividend yield of a company operating in such sectors. Investor expectations and market conditions. Investor expectations and market conditions can also influence a company's dividend policy. Some companies strive to maintain a consistent or increasing dividend payment history to attract and retain income-focused investors. Market conditions, such as interest rates or investor sentiment, may also influence dividend policies and, consequently, dividend yields. It's important to note that dividend policy decisions are made by the company's management and board of directors, considering a range of factors and the company's specific circumstances. These factors collectively impact the dividend yield, as they determine the dividend amount and frequency of payments. As an investor, understanding these factors can provide insights into a company's dividend policy and help evaluate the potential dividend yield of an investment.